Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to our regular weekly strategy update. Last night saw the sharpest fall in US and world indices since mid-March. Indeed, if this had been a year ago, it would have been the sharpest fall for 8 years, which shows you just how immune we're getting to market volatility. Why did this happen? Will it continue? Does it alter our midterm outlook for asset prices? Those are the questions I'll try and reflect on today. The first factor was some slightly worrying news from about COVID infections, particularly in the US. I've shown them slightly differently this time, but the big yellow bands show the infection in the Americas. At 3.4 million of all infections, that's nearly 50% of the 7 million total. Purple Eastern Mediterranean, pink Europe, and blue, the very small now infection rate in Asia. What worried people was not only the size of the yellow blob, but the fact that 12 US states have seen a pickup in infections this month, particularly Texas, Florida, Arizona, high areas of retirees and older people, pressure on hospitals, Houston talking about renewing a potential lockdown. This is important because GDP is heavily dependent on what we call the Global Stringency Index, which we've looked at before, which shows how tight the lockdown is. Note China still the tightest of the major countries, extraordinary given how low their current infection rate is, slightly worrying. UK ticking up as we put in our quarantine measures last week. Germany and Italy now at roughly 50% of the peak measures. The second reason I think for the market correction was a dose of reality, particularly from Jerome Powell of the Federal Reserve. He reminded us this is a big crisis, a 3-year workout at minimum, risks of core inflation falling further, and an extraordinary forecast that interest rates are effectively at zero out to 2022 and beyond. You can see this on the right in the famous US Federal Reserve dot plot, which shows voting participants who vote on interest rates, assessment of appropriate policy. Look at those dots, close to zero 2020, 2021, and just 2 outliers on 2022. I've never seen anything like this. And it shows just the level of, if you like, financial repression. The Fed also talked about managing the yield curve. In other words, targeting the rates a little longer down the curve. Radical policy, again, but actually broadly supportive of asset markets. The final dose of reality was some horrific, shocking numbers out of the UK this morning in terms of GDP, a 20.4% fall in April 2020, which takes us back in growth terms to where we were in 2002, 18 years ago. Just the magnitude of the drawdown, I think, is a stark reminder to the world of the damage that we're seeing and will be likely replicated around the world, particularly in emerging markets. So what did this mean for asset prices? Well, you can see on the left the extraordinary rally in world equities since their low on the 23rd of March has been somewhat reversed. We got to break even in sterling terms, extraordinary, and we're now down 3 or 4% for the year to date. Gold ticked up, gilts ticked up. And on the right, where I look at the equity markets from their low, that extraordinary rally in the S&P 500 equally weighted, which doesn't give the bias to those huge tech stocks, which has seen some of the industrials and cyclicals rally quite sharply reversed. But note, still up 35, 38, 39% from the lows of 23rd March. What do we think going forward from here? Well, first of all, some correction was likely. This rally was extraordinary. In the last 10 weeks, every single member of the S&P 500 was up, almost unprecedented. This caused, I think, some excessive exuberance in markets, and the famous S&P 500 put-call ratio, which measures how many people are bearish buying puts, how many people are bullish buying calls, had gone to its lowest in 9 years just a few days ago. It's now rebounded, but that shows that call-driven sentiment. On the other chart, the volatility numbers, which have fallen dramatically. But if you look back to 2008-9 in these crises, there are aftershocks, and volatility surges are entirely normal in the weeks and months following a major sell-off. So what's the future? Well, first of all, we have extraordinary backing from the central banks. Total central bank balance sheets now $20 trillion, expanding on my calculations at 3 times the rate they were in 2008-9. And that, as it did in 10 years ago, should ultimately bring down volatility. Secondly, the dollar has not aggressively rallied. Remember, when the dollar rallies, that has the effect of tightening financial conditions in the rest of the world. In fact, as you can see on the left-hand chart, the dollar index has actually come off quite sharply in the last few weeks. And the major currency crosses on the right, leveled at 100 at the beginning of the year, are broadly flat today. Thirdly, the aggressive cuts by OPEC-Plus, that's OPEC-Plus Russia, seem to have worked and stabilized the oil market. Now, we don't want a huge rally in oil prices, but we didn't want the sharp deflationary effect that $10, $20 oil was causing. This appears to be off the agenda. So that's contributed to our key indicators. 5-year forward US inflation rates broadly stabilizing. They've come off a little bit, but not indicating a high deflation risk. And that measure, the Italian-German bond spread, which shows, if you like, the risk of Eurozone breakup coming back dramatically, particularly on Mrs. Lagarde and Ursula von der Leyen's interventions in the QE and fiscal space in Europe. So what does that mean for the future? We are holding our equity allocations at neutral. We do think generous central banks and a very thematic portfolio emphasizing climate change, global healthcare, automation, digitization can still perform, particularly when interest rates and bond yields are so low. We are cautious, I'm afraid, still on the emerging world, continue to hold our gold and cash positions, albeit the gold slightly smaller, as defensive buffers within the portfolio. And selectively, where prices allowed, say last week before the sell-off, we're continuing to implement modest levels of portfolio insurance. I hope that's helpful. Thank you.